The stock market rallied today. After this 10% correction, it's the first bounce that looks like a bounce. We've had intraday rallies before, anywhere from 1 to 2%. That's happened almost every other day. This time, you're up about 2.5% from your lows, okay? And, well, there's a little bit more momentum behind this one. Here's the deal, though. Here's the problem. The data that we got today was terrible. The data that we got today confirms that the U.S. economy is heading into a recession. At least the labor market is about to massively deteriorate. And there's a lot of historical precedents for this, and it's a leading indicator. And really, if you guys just want my opinion, this is a tactical bounce. This is a way for hedge funds and institutions to reduce their positioning in markets at slightly higher prices to slow down some of the selling. Yesterday, we had an RSI of 27. Today, we have an RSI of 37 with a 1.85% green day. You could fall 2% on Monday back to new lows with the RSI not again at 27. This is what we've seen during 2022, where the markets would fall and then rally and then fall and then rally. It's because you can't just go straight down forever, right? From a tactical perspective. Like throughout this 25% drop on markets, you were only ever oversold right here with an RSI of 24. That was late January 2022, you ended up bouncing, right? And then you came right back down, hit new lows. RSI did not hit new lows. Then you rallied again, came back down. RSI did not hit new lows. So throughout 2022, from the January low, you actually fell you fell 20.5%. You were in a bear market and still not at new lows on the RSI. Still, even back here, in June of 2022, you were down 24%. The RSI was still not oversold because you had these bounces. And that is what we are seeing today because the data does not support a bounce. And that's when you really want to be careful when markets are moving for no reason. So first and foremost, the big data today was the Michigan Consumer Sentiment Report. And as expected, this thing is terrible. The headline number came in at 57.9. Last month, it was 64.7. The estimate was 63.1. So yeah, you came in well below where Wall Street was expecting. 5-year inflation expectations hit 3.9%. We were expecting 3.6%. Last month, they were 3.5%. Yikes. Longer dated inflation expectations are rising. This is actually the highest level you've seen since 1993. You have 1-year inflation expectations that hit 4.9%. Last month, they were at 4.3%. And the estimate was 4.4%. So 1-year inflation expectations also moving higher. But what stands out to me in this report is consumer expectations. Consumer expectations plummeted. Last month, they were at 64. You fell to 54.2. You were expecting this to actually move up a little bit, for people to actually feel a little bit better about the future. You were expecting this, again, to go from 64.0 to 64.3. Instead, the opposite happened, and you fell 10 points. And when you look at this from a recent history perspective, you've fallen off of a cliff. Like every month has been worse than the last. And now you just look awful. You're getting back to the lows of 2022. The only time you were lower than this was June and July of 2022, when inflation was like 9%. Okay, and stocks were down like 25%. This is really not a great sign for the consumer. In the summary of this data, it says the University of Michigan consumer sentiment for the U.S. plunged to 57.9 in March of 2025, the lowest since November of 2022, from 64.7 in February, and well below consensus forecast of 63.1. Preliminary estimates showed sentiment declined for a third straight month, with many consumers citing the high level of uncertainty around policy and other economic factors. While current economic conditions were little changed, 53.5 versus 65.7, expectations for the future deteriorated to 54.2 versus 64 across multiple facets of the economy, including personal finances, labor markets, inflation, business conditions, and stock markets. Meanwhile, inflation expectations surged, with the year-ahead gauge rising to 4.9%, the highest reading since November of 2022, from 4.3%. Also, inflation expectations for the next 5 years surged to 3.9% from 3.5% in February, the largest month-over-month increase seen since 1993. Renaissance Macro Research says the big news in the UMISH data was not inflation expectations. Look at what people are saying about the jobs market. Expected change in unemployment is the worst since the 2008 recession. No one is asking for a raise in this environment. Just look at this. That is absolutely terrible. And what's alarming is these things tend to historically follow each other, right? You tend to see, this goes back to 78, right? 1978. These charts look pretty much identical. One can, come first before the other. And again, if that's true, you're going to be in a recession in the not so distant future. Again, maybe that they don't correlate. Maybe things are just fine, right? Maybe payrolls continue to be okay, and you have the first real separation here, like ever. Who knows? Maybe that's possible. I think it's improbable, very improbable, looking at this chart. And that is why, unfortunately, these rips will be sold. Investors will continue to sell the rips more than they buy the dips. You can even see with today's rally, it is a fraction of the volume we have seen on any given day. It's like volume today just really fell off a cliff, okay? Not exactly a great sign if you think this is a durable market bottom. Now, with this market, we're so heavily driven by news headlines and what Trump has to say, he could probably stop a lot of this pain quickly, but the overhanging issue still remains. The economy is weakening. We are heading towards a recession, at least in that direction. And if the economy is weakening, you're heading towards a recession, people don't want to go out and buy the dip on a 10% correction. That's just not, again, that's not a good risk reward setup, especially again considering we were just at all-time highs and you've rallied 20% in back-to-back years. Our expectations just got flipped on their head. Okay, we were all expecting a pretty good economy, a cut or two from the Fed this year, but no big rush. Like Trump's trade war, that's just negotiating, right? That's kind of the consensus why stocks were at all-time highs. Well, now we're realizing, oh crap, Trump means business with the trade war. They're willing to sacrifice the economy to get there. Inflation is still an issue. The Fed looks like they're not going to be saving the markets or the economy anytime soon. And again, it looks like we're heading towards recession. That backdrop is not a great one for stocks. And when you were at all-time highs, it makes sense why you've had one of the fastest 10% declines in market history, because our expectations were wrong. What we were pricing in was proven incorrect in a very short amount of time. Does this mean that you're accurately priced for a slowdown in the economy? No, we're not. And while you can get bounces, and I expect we will get bounces, they will be sold off. Again, yesterday, the markets were the most oversold they have been at since September of 2022. So you were only down 10%. It just happened quickly. In 2022, you were down like 25% before you were this oversold. And that's just because we had bounces, right? We had bear market rallies. We fell a bit, rally, fall a bit, rally, fall a bit, rally, and just repeated that cycle over and over again and slowly made our way lower. This time, you've done it very fast. Also, in the consumer sentiment report, it is interesting because inflation expectations really across all demographics went higher. Okay, you can see this here based on political affiliation. So you have Republicans at 0.1% inflation. They're almost expecting deflation. Independents expect 4.4% inflation. That is up from 3% in the prior reading. And Democrats expect 6.5% inflation. Like, no, this doesn't make a whole lot of sense, right? This is like very idiotic, okay? From an actuality perspective, like oil is falling, economy is weakening. Yeah, sure, tariffs are not exactly great on inflation, but the expectations are high, right? They're kind of misaligned with the current situation that we're set with. There was also a big rumor today, really started by Charles Gasparino. This guy has the most outrageous rumors that are never true. He says, quote, "Lots of talk in Trump circles about the need for some grand plan to resolve the tariff disputes with Mexico, Canada, and Europe. That is, cut a deal via one universal settlement. This started bubbling after today's market losses and the growing sentiment that the market upheaval isn't over until this stuff is settled. I have no clue whether this is something the White House is working on, but the chatter among the outside advisors in and around Wall Street and DC is real. The idea is that a compromise. Trump saves face with the base, the trading partners who are now hurting economically because of the uncertainty all get relief. The administration then can move on and focus on broader parts of its econ plan, like DOGE, budget reductions, tax cuts, and deregulation." Donald Trump on Truth Social said, quote, "Our economy will boom like never before." U.S. Secretary of State Rubio says tariffs are not meant as hostile moves. He goes on to say that once trade baseline is reset, then the U.S. can engage in bilateral negotiations for fair long-term trade arrangements. Rubio also says that there is reason to be cautiously optimistic on Ukraine-Russia situation. And Zelensky says that we now have a good chance to end this war quickly. Also, probably helping markets to bounce today, Chuck Schumer announces that he will be voting for the federal funding bill as we get to the midnight deadline, which raises the odds that, or lowers the odds, I should say, of a government shutdown, right? It raises the odds the government will get funded. And again, normally government shutdowns are not huge negative catalysts for markets. Usually it doesn't do anything to markets. Historically, markets actually go up during government shutdowns. But with fears of the economy already weakening, fears of a recession already materializing, to not pay people for a period of time doesn't exactly help things, right? And that's why this could have been a negative catalyst. I don't know how much of a positive catalyst it is either. Again, historically, it's not really a catalyst at all for markets. But it looks like it's going to pass, and that could be fueling some of this market bounce because you were so oversold. You can also see that Putin says that talks with the U.S. are starting to move, and let's see what comes out of it. So people are getting excited that the end to the war in Ukraine could be coming. And I'll tell you one big thing that will do right off the start. It would lower oil prices, right? To allow some Russian oil to hit the global market. That should lower oil prices even more. And that is a positive for the economy. So structurally, the war in Ukraine ending, it's not really a huge catalyst. But when you think about the second derivative moves of that, like lower energy prices, Ukraine is considered the breadbasket of the world in terms of wheat and the food that they produce. Two big areas of inflation, right? Energy prices and food prices could come down as a consequence to that war ending. And that is a positive for markets. And one of Bank of America's strategist, Hartnett, says Trump will flip on trade policy before this turns into a bear market. Which, if that's really your investment thesis at this point, you must have not been paying attention to everything the Trump team has been saying. Detox period, transition period. They don't care about short-term market losses. I don't think a bear market's gonna stop Trump. In fact, I think Trump wants a recession. I think Trump wants a shallow recession to kill inflation, to get treasury yields lower, and this is working by design. But again, this is a healthy bounce in markets. It's pretty abnormal and unhealthy to see markets fall 10% with only really getting intraday bounces. Right? You've basically went straight down, and you're finally getting what looks to be a little bit of a base being formed. But ultimately, to me, this just looks like a bear market bounce. Obviously, we're not in a bear market yet, but I think Wall Street's going to continue to sell the rallies, and I think you're going to fall further. So, if you're a trader, then I think you could trade this market up to that 200-day moving average around 570 on the SPY. But anything above that becomes really hard to grapple with unless something dramatically changes. It's pretty clear to me the economy is slipping closer to recession. We're not priced for that. And I don't know what good could really offset that. With the Fed on pause, it's not really anyone coming to save the day. Doesn't look like the trade war is going to be over anytime soon. Until something breaks, I'm going to trade this market, but I'm not going to go all in on a 10% drop. Once we're 20% down, then we can talk about a better risk reward profile. But again, part of the reason we fell 10% so fast is because just a month ago, nobody expected the economy was slipping close to a recession. Nobody thought that Trump was serious about a new trade war and going to escalate that situation, right? Nobody was concerned about inflation coming back or stagflation. We were all kind of caught off guards from a market's expectations perspective, and now we're just forced to rethink all of this, okay? And 10% I think does a little bit of that, but it doesn't account for the recession risk. And I think that the next 9-10% lower on markets starts to account for some of the recession risk. And ultimately, my target's around 500 on the SPY without a recession, right? Just as recession fears build, as the economy continues to slip, that would ultimately be down about 18.5% from all-time highs. That's my opinion. That's my projection. But if we did go into recession, then you could fall even another 20% below that. It could get really nasty. And that's why I'm not in a huge rush to go out and, spend all of my dollars to get into markets at these levels. I haven't sold any stocks, and I'm fully positioned for the upside, but I'm just not putting new capital to work right now. Unless it's a very specific opportunity. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day and your weekend. I will see you in the next one.